Credit unions will mail out life insurance offers from time to time. Are they a good deal? And should you buy life insurance from a credit union?
We did an episode recently where we talked about the things we wish we had learned about finances before we turned 18. We had somebody say they wish they'd known their money could work for them and how it could work for them. It sounds cliche, but when you think about it, it's magnificent. What a nugget if a teenager understood that their money could work for them. It could change their life big time.
No doubt it could. We should talk about ways to put money to work later in this podcast. But first, let's talk about this credit union life insurance dilemma.
I remember when my dad as a teacher joined the teachers credit union, and all of us children, we joined with him and started our savings account. And with that came a little piece of life insurance because the credit union was trying to show us that savings was important, but so was life insurance. I don't see those free life insurance offers anymore. All I see is these ones that come in the mail giving us a so-called great offer on life insurance coverage.
So you still have to pay for it.
We still have to pay for it.
But supposedly it's going to be a good rate. It looks special. It comes to you with your name on it. It's coming from a trusted source. And sometimes you don't even have to go through underwriting for these offers or through the traditional underwriting, giving blood and urine. You just have to go through abbreviated underwriting. So where they look at different financial records, health records, and they tell you whether you're approved or not.
And it feels kind of like a perk because you are getting this offer because you are a member of the credit union. So recently we had some offers come to us in the mail. For a younger person, it was for term insurance. So let's look at that term insurance.
We have here a proposal from the credit union with their insurance rates. They have rates for women and for men. They have amounts of insurance for $25,000, $50,000, $75,000, and $100,000.
When we make a comparison of those rates, the lowest we can go is $100,000. So that's what we're going to use for this comparison.
The credit union offers $100,000 of life insurance to women age 25 to 29 for $25.50 a month.
And you might be surprised to know that 10 years of insurance that we can offer is $10.38 a month.
That's almost 150% difference in price.
Yeah.
The credit union insurance rate is only good for 5 years as well because it goes up every 5 years because these are 5-year bands. So the price on the insurance we can do for people, that's 10-year level term, isn't it?
Well, yes, but you could get 20-year for $12.28 a month or even 30-year for $16.18 a month.
That's still less than the $25.50 a month for the first 5 years with the credit union
insurance.
Yes,
it's way less. And like you say, that's only for the first 5 years. After that, it's going up. There's no reason for it to go up.
Well, if you were 50 or 55 years old, that credit union offer might be a good deal because that's what we can offer for someone in that age bracket for $100,000 of coverage.
For 10 years.
For guys, the rate is even higher. For guys to get $100,000 of insurance on the term, the credit union offer, it's $42.50 a month.
And here it's $11.24. So still, 20 years, $13.76, 30 years, $19.22, still about half of what you'd pay for getting term insurance through a credit union.
So these term insurance offers come through your credit union because your credit union has joined in with either a marketing group or an insurance company that wants to exchange your information for valuable consideration for the credit union. They are not necessarily a good deal. Obviously here, there are better deals out there.
Something to think about when you get credit union, if you had credit union life insurance already, or if you have a little bit of insurance coverage through work or through some professional group that you're a part of. Sometimes people look at that insurance coverage and that box is checked in their mind. Oh, I have life insurance coverage, but it's usually for a very small amount of insurance coverage. $25,000, $50,000, $100,000. That's not very much life insurance when you come to think of it.
The other thing that a lot of these credit union offers are for accidental death life insurance. And that's a whole nother ballgame. We use accidental death riders on life insurance in case you're involved in an accident when you die. It boosts your death benefit up. But some of these policies are just if you die in an accident. And the risk of that happening is so slim that this is very profitable for the insurance companies that are making these offers.
So another offer that came across our desk was a whole life insurance offer from a credit union. And this was on your life, Tom. And the highest amount of coverage they would give you was $20,000. For the first month, you'd only pay $1. How nice. But after that, it was going to be $104.60 a month. So I did a comparison, of course. The lowest we could go is $25,000, and it would be $88.83 a month. That's 15% lower cost for $5,000 more coverage. And then I ran the illustration for that to see, would that be a good deal even if we sold you that policy? And no, it really wouldn't be a good deal. Yes, it's whole life insurance, but the amount of money you're putting to it at your age, you're going to end up spending more for the life insurance than what you get out of the life insurance unless you die by the time you're 80. And I don't want you to do that.
So $20,000 is like a burial insurance policy, and you can go to the funeral home and you can buy one of these policies and pay one premium, be done with it for the rest of your life, no matter how long you live. So do you want to pay that $100 and some every month for the rest of your life for only $20,000? Probably not.
With the whole life insurance that's coming through the credit union or this quote that you ran, that doesn't include anything with the paid up additions rider. That's just base whole life insurance. So that wasn't worthwhile to buy. Sometimes for people in their 60s, it is still worthwhile to buy life insurance that has that paid up additions rider on it, because that jump starts the cash value growth. That jump starts the benefits that they're able to receive back out of that policy. So it's going to break even sooner, and it's going to be potentially a better deal depending on how they're looking to use that in their financial situation.
Credit union life insurance might be better than no life insurance at all, but obviously there are better deals. When we get back from the break, we're going to talk about how to put your money to work.
Did you ever play with a set of these rings growing up? They make a great visual picture of how you should set up your finances. On top, you have the higher risk investments, the lower risk investments. This ring is debt, this ring is savings, and this ring is protection. This stand represents the economy. If there's one thing we know about the economy, is that it will change, and it does, and this can change. It's unstable. What some people do when they set up their finances, they take and they go for the shiny, high risk, potentially high yield investment. Now, potential return does not mean probable, and it is definitely not probable. So this doesn't perform as well as they hope, and they think they should add a more conservative investment that actually might return something. So they add that, and believe it or not, some people will go into debt for that. Add that to the debt they already have, and there's their debt ring right on top of that. If you are listening to this podcast, I hope that you have time to click the link in the description for the YouTube video, and we'll tell you where in that video you can see this demonstration, because it really comes alive when you see it. Well, you have these three negatives, these investments that aren't returning as well as you had hoped, and your debt, which is just a draw on your finances. And people think, I should probably save something. So they add savings to that. Then they look at what they have going there. It looks a little precarious. So they plop some protection right on top of that. Well, if there's one thing we know about the economy, is that it will change. It is uncertain and unstable. And as soon as it changes, you lose your protection and your savings, which are the two things you want to keep most. That's the importance of doing it right. Start with protection. That makes a nice foundation for everything else you do financially. Once you have protection in, then add your savings program so you can keep more of the money you make. Next, make sure your debt is handled. Pay off the bad debts, keep the good debts. A good debt is one that gives you a tax advantage or limits your opportunity costs and allows you to make money. Once that's handled, you can do an investment. Hopefully this is something you know about, because those type of investments that you know something about tend to return better. And if you have extra cash flow and want to go for one of those potential high risk, high reward investments, then you can do that too. Now, when the economy changes, you're much more secure. At McPhee Insurance, we specialize in helping people set up this layer, the protection layer, the foundation for what they do financially. We specialize in designing and selling whole life insurance that becomes this protection layer for you. It's a good foundation for everything else you do financially. If you need life insurance or if you need to get a life insurance policy you already own reviewed, we can help you with both of those things. Contact us by phone at 702-660-7000, or you can email us, team@mcpheeinsurance.com.
When you put your money to work for you, you don't have to earn every dollar of your income because your money is earning income for you.
One way to put your money to work is not buy a credit union life insurance.
To understand how to put money to work, we have to understand what money is. And there's 5 things that define what money is. It has to be fungible, it has to be durable, it has to be portable, it has to be recognizable, and it has to be stable. And by fungibility, that means that whatever I'm spending as money has to be recognized and can be exchanged for a variety of different things. With my dollar, I can buy a car, or I can buy an apple, or I can exchange it for you for a service. If there's something that I exchange for a service or a commodity, like I'm trying to take an apple to you in exchange for a cinnamon roll, that's barter. That's not money. Fungibility means that it can be used for multiple different things.
And fungibility also has to do with the fact that $1 is equal value to another dollar. I don't care which dollar I get in a transaction. It's going to be of equal value. I can turn it around and use it for anything.
So you just
$1 looks just like another dollar in my pocket or in my bank account.
You just want one with George Washington on it.
It has to be durable because it has to be able to store value. If I put $1 away today and spend it next year, it still has to be recognized and be worth $1. That doesn't happen with some things because of their volatility. Of course, inflation makes our own dollar volatile, but it's less volatile than some other things that have been used for money in the past. It has to be portable. A lot of people say, well, I'm going to go and make gold and silver my money, and that's fine. It has been recognized as having value. It's fungible, it's durable, but it's not real portable. It's hard to take a chunk of gold down to buy a car or to go to the grocery store and get change for a gold bar to buy your groceries. So the portability of gold has made it really not a currency of money for us in our society today.
I'm just getting a picture of that. You go to the cashier and you get out a gold bar and, what are they going to enter into the register to figure out the change? That's a funny picture.
Yeah, it has to be recognizable and stable. And you talked about that, John, already. Every dollar looks the same or similar. We recognize, oh, that's $1. This is a $100 bill or this is a $50 bill. $2 bills, though, are not really recognizable in many places. And I just read a story about the other day. A banker was saying, don't ask for them because you're going to find that a lot of places won't take them as money anymore because they don't recognize what they are. They're still a currency. They're still recognized by the U.S. government, but some retailers say no. Finally, it has to be stable. If money is not stable, then it becomes worthless. These monies, these currencies, these papers were once money in Germany right as World War II started, but they were used as packing paper to ship goods to this country from a friend of ours. These currencies were worthless because German workers were getting paid and they would rush their money to the gate, shove it through the cyclone fence to their spouse to go buy groceries because by the time they went to the grocery store, the money had already devalued so much that it wasn't worth what it was at the beginning of the worker shift. When that happens, money becomes worthless, just like this money was, and becomes trash or packing paper.
There is a difference between currency and money. Those are some of the conditions that you spelled out that makes a currency money. All of those factors have to be present in order for any currency to be used as actual money. And now that we understand what money is, we have to think about it right, because we can understand what money is, we can use it, but if we don't think about it right, then we're not going to keep very much of it.
I remember when I was helping my nephew learn how to save, and he wanted to buy this little race car, remote control race car. And he saved his money and he worked in the yard with me and I paid him and we stored it up. And then when we went to the store to buy the race car, I made a devastating mistake. I bought it on a credit card. And he thought I had stolen his money. These things that we just talked about We kind of understand them intuitively because that's what we've grown up with. But the way we think about money can really affect the way that we behave with money.
So his lack of knowledge, lack of understanding and experience at that young age left him with a sour taste for how you had dealt with him with the money. And then that had to be explained to him.
Yes. When people begin to use their money and manage their money, the way they think about it really can affect the outcome. So how do you think about money? Do you think of it as just a medium of exchange? Do you think of it just as, oh, I'm changing my time for money? And a lot of people do, and that's a slave mentality. The richest man in Babylon talks about that. Money should be something that we work for so that we realize that we are providing a service for someone else, and the money that we earn will take care of our needs, plus be able to help us do something for somebody else besides ourselves.
So I'm thinking of somebody right now, we'll call him Aiden, and he just wants to make money, to have money, and to have the things that money can buy. And he's been jumping from job to job, just whatever can make him the most money. He doesn't really care about service to other people or the value of what he's doing. He's just valuing the outcome, the money, so that he can go buy the new car. And will that satisfy? No, because once you have the new car, you got to go buy the next new car. Or maybe it's the house, buy a mansion. But once you have it, there's another mansion down the road. And so his idea about money, it's not really creating the value that it could in his life or the lives of other people, because all he wants is that money, and he's never going to be satisfied with getting that money to produce some sort of show of what he's worth.
There's also someone that we'll call Tiffany, who's a spendthrift, and she'll spend everything that she makes. She can make a little bit of money, she'll spend it all. She can make a lot of money, she's going to spend it all. It's just the way that she handles money. She's going to spend it if she has it.
Those type of people, if they're in the lower income brackets, can't pass a garage sale up because of the bargains they're going to get there. Someone that's making millions of dollars can't stop shopping at Tiffany or Gucci or all these other places so that they can show everybody what they've got. So it's not a matter of how much money you make. It's what you think about money. What is its purpose? What is the purpose of money? Solomon told us a long time ago that if our purpose is just to get more money and the things money can buy, we're never going to be happy because there's always something more. And part of that is an incentive for us to work harder to get those things. But if that's the only fulfillment that we're going to get, it's going to be very empty and shallow when we get there.
We want to see money as a resource, not as the end goal. It's a measuring stick. What is our service to other people? Earl Nightingale had a great way of talking about this. He said, if you want to increase your rewards, the money that you're getting in life, think of ways to increase your service. You can think of it as the old-fashioned scale that has the balancing arm with the two bowls on either side. And if one bowl is marked service, the other bowl is marked rewards. If you want to increase your rewards, you also need to be able to increase your service so that the scale stays in balance.
We go back to the parable that Jesus said, if you manage that money well and you're focused on what can I generate so that I'm providing the best service for somebody else, that's going to be rewarded by you being able to do more services to make more money. Whereas if we're just greedily pushing to make money, we often will fall into the trap of shortchanging the service that we're providing just so that we can get more money.
So when we've got the money, now we need to talk about how can we get our money to work for us?
40 years ago, when I was just first starting chiropractic practice, one of my patients, Gil Liming, I'll never forget, very, very wealthy individual. He owned a company that sprayed the railroad right away from the Mississippi all the way to the Pacific coast, all the railroads. And I asked him, Gil, what is it that I can do that can help me manage money better? And he said, think in percent. I said, what does that mean? He says, you go to the store and there's 2 cans of green beans and you know they were both canned at the factory right down the road here. Which one are you going to buy? The one for 33 cents or 34 cents? I said, well, I'm Scotch. I'll probably buy the 33-cent one. He says, why? And I said, because I want to save a penny. He says, no, you want to earn 3%, over 3%. And I kind of scratched my head because I didn't realize that the difference between 33 cents and 34 cents is over 3%. He said, would you be happy to get 3% more in your savings account? Then make sure that happens every time you go to the store.
Well, green beans are a lot more than 33 cents now. They're more like 85. But still, we can put these same principles to work, no matter how much the cost of the green beans is, the can of green beans. We're still talking about the principle and the percentage of savings that we're making or interest we're earning.
At the same time, we have to be careful about coupon shopping too, because you and I were at Kroger's the other day, and we were running all over that store trying to find the little coupons that they'd sent us to save a dime. We probably spent more time in that store looking for things than if we had bought them for 10 cents more at Meijer's.
And I turned to you and I said, I don't like this kind of grocery shopping. I'm not going to do it, even if they send me those free coupons in the mail.
It takes time. And that's what money is an exchange for, is our time and energy. So do we want to spend the money or do we want to spend the time and energy? And that often is the exchange that we have to look at, whether it's coupon shopping, whether it's exchanging our time or energy for money in some format. That's a healthy way to think about money.
We just gave an example of spending money at the grocery store, other places where we spend money looking for good deals. That is a way to get our money to work for us. But then there's also other ways, like putting money in CDs, buying stocks, making other sorts of investments. Those are ways to have your money increase money as well.
I just read an article about a multimillionaire the other day who was talking about how he's training his children not to think that they're just going to inherit all of his money. And he said, one thing I do is I don't pay my children an allowance. Nobody in the world gets a paycheck just for existing. And if we do that to our children, then we're training them up to think the government is going to take care of them. And the government will never take care of you the way that you can take care of yourself. The second thing he says, I teach my kids never to spend money on something that they haven't fully investigated. This goes for even buying a car or goes for an investment. It's something we tell people all the time when they say, what should I invest in? I say, don't invest in anything you haven't fully investigated. Because 9 times out of 10, if you invest in something you don't understand completely or to a fuller degree than most people, you're going to end up the loser.
I'm glad that you didn't give me an allowance growing up. That's an entitlement mentality. It teaches wrong thinking about money, how to get it. But what you did provide is you provided an environment where we could earn money. I remember that you helped to build the chicken house, where we could raise chickens and sell the eggs, and then we could take some of the money that we earned from selling the eggs down to the feed store and buy the feed. And we would buy feed occasionally, but before the chickens were laying, you bought the feed. And I remember scratching my head at some point and thinking, if we were really doing this as a business, we'd have to do this a lot more efficiently to be able to make money. But it gave us a chance to earn that money instead of just being given that money as an allowance. Later on, we worked for the neighbors. We had the environment, the foundation at home that we could go and work for the neighbors, earn some extra money as we were growing up. And then later on, we were able to work in the family business and earn money that way, to start our own businesses using the family foundation. We're able to grow in that respect. So not having an allowance, but having the opportunity and the foundation to grow in other ways, extremely grateful for that.
Money working for you earns interest. That is the wage money earns. Some people have a hiccup when it comes to interest. They don't want to pay interest to anybody because they think they're going to be their slave. But the wage that money earns is interest. Even our Lord Jesus talked about, you should at least put the money in the bank so the interest that belonged to me would have been here when I got back. So interest isn't the problem. It's when we are charged an exorbitant amount of interest, which becomes usury. And so that is something that you have to decide personally whether the interest you're charging for people to use your money, or the interest someone else is charging for you to use their money, if that's usury or not. It depends. In our system of government, the Federal Reserve sets an interest rate. Sometimes that interest rate feels like usury. And back in 1980, it was 21%, and if you weren't prime, you paid more than that. So that really curtails a whole economy. But if you're paying more interest on a credit card, for example, and we see people paying 22, 29%, that's usury. That's bleeding to death financially. And so the way you think about money and the way you spend money will keep you from getting in a position to paying more interest for the use of someone else's money than you should.
Many people's need for financing in their lives is much greater than their need to earn a rate of return. All the different ways that you can put money to work, earning interest, earning in an investment, those are exciting possibilities to look at. But let's make sure that we start at the foundation, making sure that we have enough financing to cover the things that we need in our life, things that we understand a lot about, things that we can recover the interest on, not pay the 22%, the 29% on the credit card. Let's bring that money home, keep it at home first before we look for additional ways to earn and to invest.
That's why we love the infinite banking concept. Absolutely love it, because now we get to store money in a life insurance policy, and it can continue to earn its wage, interest, while we get to leverage that money and use the insurance company's money to go out and make purchases. And when we do that, we have the chance and the opportunity to recover the cost of what we just purchased. It's all the way you think about money, the way you manage it, and what you're thinking investments are.
The infinite banking concept, it allows us to work with our money in infinite ways to keep more of the money we make and produce wealth.
Let's keep doing this. This is exciting. If you have something that you wished you knew before you were 18 about finances, put it in the comments, and we'll address it right here on the podcast.
We can't wait to see what you'll say.
And come back next week, because we have another video of Dave Ramsey sent to us by a listener, and we're going to talk about it next week right here on Wealth Talks.